We just witnessed one of the most monumental events of the entire decade, and yet most Americans still don't understand what has happened. In recent months, the global economy and stock markets around the world have been buoyed out by the hope that the United States and China would soon sign a new trade agreement. Fortunately, there is no way that is going to happen now. On Tuesday, the Senate unanimously passed the Hong Kong Human Rights and Democracy Act of 2019, and the House of Representatives passed the same bill by a 417-1 vote on Wednesday. Needless to say, the Chinese are beyond angry that Congress has done this. China is warning the United States to rein in the horse at the edge of the precipice, and that there will be revenge if this bill is allowed to become law. And it looks like this bill will actually become law, because Bloomberg is reporting that President Trump is fully expected to sign it. The global economy has already entered a very serious slowdown. One of the only things that could reverse our economic momentum in the short term will be a comprehensive trade agreement between the United States and China. But now that our relationship with China has been destroyed, there isn't going to be a deal. As the two largest economies on the entire planet decouple from one another, it is going to cause a global economic activity as a whole to dramatically slow down. Corporate revenues will fall, credit markets will start to tighten, and fear will increasingly creep into global financial markets. This conflict with China will be more than enough to push us over the edge. The outlook for 2020 growth has stopped getting worse. Upticks in forecasts remain tiny according to data from Consensus Economics, which averages forecasts from major independent economists. After watching the slide in the global economy over the past 18 months, Peter Hooper, global head of economic research at Deutsche Bank, noted that in recent weeks there were tentative signs of an easing in the downward trends. Those signs are still nascent. Some are celebrating the end of ever more gloom in forecasts. There are definite signs among global activity indicators that the worst of the slowdown is behind us, said Ines McPhee, Managing Director of Macro and Investor Services at the consultancy Oxford Economics. That's certainly the warning embedded in the new economy outlook from the Organization for Economic Cooperation and Development. The group now forecasts that global GDP growth will sit at 2.9% in both 2019 and 2020, the lowest annual growth since the financial crisis. It's expected to tick up just 0.1 percentage points in 2021. From OECD chief economist Lawrence Boone, it will be a mistake to consider these changes as temporary factors that can be addressed with monetary or fiscal policy. They are structural, without coordination for trade and global taxation. Clear policy directions for the energy transition, uncertainty will continue to loom large and damage growth prospects. In the United States, growth is forecast to slow from 2.3% in 2019 to 2% in 2020 and 2021. China is expected to post 6.2% growth this year before it drops off to 5.7% and then 5.5%. In a sentence, the global outlook is fragile, with increasing signs that the cyclical turndown is becoming entrenched. To rejuvenate growth, policymakers must undo the trade barriers put in place with durable agreements, rein in geopolitical tensions, and reduce domestic policy uncertainty. Such actions can help boost confidence and reinvigorate investment, manufacturing, and trade. In this regard, look forward to more details on the recent tentative deal reached between China and the United States. We welcome any steps to de-escalate tensions and to roll back recent trade measures, particularly if they can provide a path towards a comprehensive and lasting deal. To fend off other risks to growth and to raise potential output, economic policy should support activity in a more balanced manner. Monetary policy cannot be only game in town. It should be coupled with fiscal support where fiscal space is available and policy is not already too expansionary. Countries like Germany and the Netherlands take advantage of low borrowing rates to invest in social and infrastructure capital, even from a pure cost-benefit perspective. If growth were to deteriorate more severely, internationally coordinated fiscal response, tailored to country circumstances, may be required. Global outlook remains precarious with a synchronized slowdown and uncertain recovery. At 3% growth, there is no room for policy mistakes and an urgent need for policymakers to support growth. The global trading system needs to be improved, not abandoned. Countries need to work together because multilateralism remains the only solution to tackling major issues, such as risks from climate change, cybersecurity risks, tax avoidance and tax evasion, and the opportunities and challenges of emerging financial technologies.
Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.